Well, I'd like to just start off and welcome everybody to the August the 24th Town Hall meeting. Every couple of weeks we get together and kind of talk about some of the current topics of what's going on in the news and in the financial world. So I'd like to thank everybody that's here. I'd like to thank everybody that's going to listen to it later. It's been one of those years. As we start to look at it, it's been a great year, and it's because people have referred family and friends. And, we just like to welcome everybody to be a part of the family. I know I'll cover this again when it's my turn to share, but at the August, new client / referral dinner, one of the things that was brought up at that event was, can you let us know when events are, so that we have the opportunity to tell our family and friends about it. So let's just look at a few of those events that are going to come up September, first part of August. On September the 14th, it's Girls Just Want to Have Guns. It's at the range in Manchester. It's been an event that we usually take between 10 to 12 ladies to. You don't have to know how to shoot a gun to be able to do it. It's if you've ever wanted to try it, please give us a call. We usually end up with a waiting list for that event, so we come from there. Then I want to say open house, the Friday at the office. On September the 23rd, Scott Stream is going to be joining us. Scott is the gentleman that if I have a referral for anybody in the Medicare area, Medicare supplements, Scott does that. He is going to be in the office on September the 23rd. So I wanted to go ahead and get that out to you all now. We do have a dinner presentation that is available on September the 27th and the 29th at Maggiano's down in Clayton. It's about, retirement in an uncertain economy. I'd say everybody right now is a little bit, concerned about inflation and all the things that are going on. So that is a presentation that is going to be done. Miss Deanna will be kicking off her second Women in Wealth, the first on the 4th and the 6th of October. We have over 50 ladies that are coming to an event that Deanna will do this month. And we believe that we're going to have a waiting list. So if you know somebody that's, ladies that would be October the 4th through the 6th, please don't hesitate to give us the name and number. They can call the office and we'll get them in on that. And also the dinner at Maggiano's, that's open to couples. So I will go ahead. I'll probably talk about those again a little bit further on down the road. But again, the clients that we're at our referral / new client dinner, they're the ones that said, give us an idea when you're having events. So I'm going to go ahead and take the first part of this and kick it over to Miss Deanna, because I know she's been spending time preparing. I'm going to kick it to her first.
They tease me. I just, this is on the record now. They tease me for overthinking what I'm going to share with you at Town Hall, but there's just so much to share, right? And so I have to pick just one. So I do. I dig a little into some of this because we want to make sure that we're bringing you value, that we're bringing you information that is relevant to what's going on with you currently. And I would say the theme among most of our client reviews right now is concerns about inflation and the market volatility, and how is that, or will it affect their overall retirement plan? Should we be making any changes? Should we be doing something? That's the big question. And it's a valid question. It's a valid question. And so one of the things that we reiterate is always the focus on the plan, because market conditions do change. And we do have to forward plan for the current conditions, not what worked 10, 20, 30 years ago. We're having to position portfolios for forward expectations. Now, we use history as a guide, right? But we all know environments change and we have to respond to that accordingly. So with the first question, I'll share just some information that I found for you. I mean, certainly inflation puts pressure on your buying power, right? And if the cost of goods and services are going to be increasing, will you be eroding your portfolio quicker than you anticipated? This is just a visual I grabbed. I'm big on visuals. It's just an image of the impact of a 2% inflation rate versus a 4% inflation rate on your purchasing power and the price increases based on that inflation. But one of the things that we address with you in our reviews is your spending plan. And have you categorized some of those expenses in your spending plan based on the inflationary factors that would be potentially affecting that spending plan? For instance, JP Morgan mentioned that the biggest spikes last year were in transportation costs. We know the cost of fuel had increased. And if you're not commuting anymore to a job, or if now you have the flexibility of working at home, is that affecting your retirement? Did you maybe potentially delay a road trip or any kind of travel due to that expense? So it affects us differently, right? Food and beverage costs, that's going to affect all of us. So have you categorized your expenses based on your basic expenses, those that are fixed and those that are variable, and your discretionary expenses, and have you adjusted any of those? Not that you should, but these are things that will fine tune within your plan. The piece that we will put more inflationary pressure on, however, which is something out of sight, out of mind, is healthcare cost. One of the biggest inflationary pressures to us in retirement is the cost of healthcare as we age. And interestingly enough, that has always run higher than the regular inflation factor that is discussed in the news. So we do need to be putting inflationary pressures on your plan for healthcare expenses. That's something we do need to factor in, whether you're paying for it out of pocket in the years between your retirement and going into Medicare. You still have expenses for Medicare. And then also, what are we going to use to fund long-term care expenses if we have an exposure, if we haven't factored in a buffer, or if we don't have some mechanism for transferring that risk? We just have to make sure that we're building that into the plan. And our health, your health factors into that, your marital status and joint assets factor into that status. So I thought this was an interesting thing. We tend to focus just on all of these on the market. And we've said this before, the investments, yes, that's a component of your plan, because we have to stay invested to stay ahead of this inflation pressure. The volatility is going to drive that short-term noise and the shorter term returns from on a year-to-year basis. But over the long term, that smooths out, and we're planning for a long retirement. So we need to have a piece in the market to be able to stay ahead of those inflationary pressures. That's why we have the structure such that we have market exposure to capture those gains and keep ahead of inflation. But we focus on, it's not returns, it's your income. It's your income that creates your standard of living, not your net worth, not the returns that you're getting on an overall portfolio. Where are we going to get your income from? So we have to structure a portfolio in such a way that we have access to funds for our short and intermediate income needs according to our spending plan. And has that changed over the last year or two? And this was an interesting piece too. The income producing capacity of your money changes all the time. And you have to assume that it's going to change when you retire. And we have to look for those opportunities to create that income stream within a portfolio. And bonds have not fit the bill for a very long time. So we use other mechanisms to create that income stream within a portfolio, whether it needs to be a guaranteed income stream to fill some gap, or if we're just creating some cash within the portfolio for our discretionary spending. That varies from client to client. But take a look at just historically, back in 2000, if you wanted to sit your money at the bank, you could get a 6-month CD at close to 7% and generate off of $1 million portfolio close to $6,000 in monthly income. But in 2014, that same $1 million with a 6-month CD only earning a fraction of a percent at 0.28%, the monthly income dropped from almost $6,000 down to $232 on the same amount of assets. So the income producing capacity of your assets matters. When you're going to pull that income matters. How we structure your overall portfolio for that income and spending need, that's what matters more than just one round. How did my portfolio grow this month, or did it go down? It's the income that we're trying to protect over time. Here was another one. Just in 2021, we were down to almost negative numbers. You're better off sitting in cash than sitting in a 6-month CD. 0.09 on a 6-month CD, that same $1 million, then you're only getting $75 a month. How'd you like to go from almost $6,000 a month to $75 a month? The income producing capacity of your money will change. And that's where we look for different opportunities. I know we've talked to many of you about structured notes. If you're looking for income and you haven't talked to us yet about structured notes or some of our dividend paying stocks, those are two components that we should be talking about. But I thought these were great visuals. And then this last piece in 2021, it would take $78 million to create that same $5,756 in a portfolio. We can't let you just sit in cash. We have to be looking for other opportunities. And as we mentioned, the markets over the long term smooth out. So we have to stop looking at that short-term volatility and know that that's our long-term bucket. So we get these two questions, inflation and markets. Well, we have to stay in the market if you're concerned about inflation. Otherwise, you're going to go broke safely sitting in cash. So that's what I had for you guys tonight.
Thank you very much, Miss Deanna. Mr. Mel, let me go ahead and let you kick off that second.
All right. Appreciate you guys being here and paying attention to us. Yes, we do tease Deanna, but she deserves it, so that's okay. Good job. It was kind of interesting because it goes somewhat with what I wanted to talk about, a little bit different, but looking at income streams when you retire, one of the things you need to be aware of is taxation. Let me make this a little smaller. Is that looking about right, guys? Okay. So they're a pretty important topic. And the question is, what will your tax rate be? I just had a meeting with a younger couple today, less than an hour ago. And we were talking about, well, what will my tax rate be in 10 years from now or 15 years from now? And the answer is, who the heck knows? There are a lot of ways it could change. We have some projections and expectations, but there are 5 different ways that you could find yourself in a little bit different taxation. Now, the normal way of people looking at it is there's one of 3 things that can happen. When you retire, you could be in a lower tax bracket. What we found over time is that that's relatively rare because of how things actually work. If you have an income and you're putting some of that money in a 401k, then you're not paying taxes on that money. Then you're paying for other things like insurances or whatever is involved in that. And then you have a bring home pay of which you then pay taxes on. So what you're living on is what you bring home with you. Now, if you're suddenly retired, we're not saving money anymore, but you need approximately the same amount of money. And we find number 2 here to be a little more accurate. They find that their pre-retirement lifestyle, they want to keep it and maybe even expand it a little bit. So they end up needing about the same income, and it's coming from their asset base plus pensions and Social Security, which are all taxable. Excuse me. So they end up in about the same tax bracket. And then occasionally we run into the situation where because they have very large amounts of money in 401ks and IRAs, more than they actually need to generate their income, they get forced into situations where they're having to take required minimum distributions. And that forces you into maybe even higher tax brackets than you were when you were working, because you can't do anything to offset that taxable income. So let's go through the 5 different ways it might work to your disadvantage. You change tax brackets change around you, deductions are eliminated, the way assets are taxed changes, and new taxes are enacted. So let's just go through each one of those independently. I just highlighted a few of these areas. The federal tax bracket, one reason that you might be in a higher tax bracket when you retire is you may be single. If you become a widower or widow, and now you're in the single tax bracket, you reach higher tax brackets at a much earlier dollar volume. Just to paraphrase it, these aren't exact numbers, but you might have to go up to $80,000 a year to get into the 22% tax bracket as a married couple, where you'll reach it at around $39,000. These aren't exactly correct, but to put it in perspective, you get to that higher tax bracket a lot quicker. And what we found over a very long period of time is that the difference in cost of living for the survivor of the married couple really isn't that much different than it was before, because we have to pick up additional expenses to offset the things that no longer go out the door. There are new expenses that take their place, including higher taxation. So that's one way you might find yourself paying more in taxes. The second one is the tax brackets could change around you. Even if you're filing saying Congress can do things to change that. For example, in 2017, they changed the brackets from where they were to where they are today. But those brackets that we're in today are scheduled to expire in 2026. Well, who's to say they might not expire next month? All Congress has to do is decide they need more tax money because of all these additional expenses that they're proposing and putting into place, these new spending issues, and they need more money. It could very easily simply say, you know what, we're changing the brackets. You now hit the higher bracket at this level instead of that level. Or we're just going to make up some new brackets that you have to pay to. Now, the pitch is that it won't happen unless you're over a certain income stream. Well, we all know what happens when they raise taxes on one group. It tends to trickle down and affect all the other groups to some extent. The question is, how severely will it affect us? So that's the second way. Not only could you end up in a different bracket because of change in your living conditions, they could simply change the structure. Now, you have a partner in all your IRAs, 401ks, 403bs, 457 accounts, all these tax deferred accounts. You don't own all that money. The IRS, the government, has allowed you to keep some of their money and let it grow until they're ready to take their share. And the tricky part is they will let you know what their share is when they're ready, and they can change their mind at any time. The third way is deductions could be eliminated. Well, we've all seen that happen. The majority of Americans today are not in a situation to do itemization of their taxation. They pretty much are on a standard setup where there's not enough deductions to offset the standard deduction. And for a lot of us, that actually puts us in less tax bracket than it would be if we were deducting. So it has been good for a lot of Americans, but it's in the neighborhood of like 98%, if I remember the statistic correctly, that people are just using the standard deductions and it doesn't really change anything. But what if they decided to change it? If you had $100,000 income and you could deduct 20,000, and so you would only owe taxes on 80. Well, what if Congress decided, okay, we want more money, so you get to deduct less? So instead of a married couple that are both over 65 to being able to deduct over $27,000, they could simply say, okay, from now on, you can only deduct 20. In this example, you went from 20 to 10. Well, now you owe taxes on 90,000 instead of 80,000. That's a tax increase. So you end up with less money staying with you and more money going to someone else. The fourth way is the way the way assets are taxed. This has happened many, many times. And before 1984, Social Security was not taxed. You didn't pay any taxes. After 1984, up to 50% of your Social Security could become taxable income. Doesn't mean you paid a 50% tax. It means you paid taxes on up to half of that income. In 1993, they expanded that to up to 85% of your Social Security could be taxable. Now, the formula they use to determine those two numbers haven't been adjusted for inflation since 1983 or 1993. Now, think about that. So more and more people are being subjected to taxation on their Social Security, even though they're not getting any more money. But because of inflation and cost of living adjustments and things of that nature, we have more of our Social Security being taxed at a level that hasn't changed for 30 years, 35, 40 years. That is a sneaky tax increase that occurs almost every single year because it's not adjusted for inflation. So that's the thing. Who's to say they might not come along and say, well, gee whiz, if you make over a certain amount, 100% of your Social Security is taxable. Matter of fact, if you make enough money, you were just not going to give you your Social Security at all. We'll just keep it and give it to somebody else. Is that possible? It's been discussed more than once in Congress. Some of the things that they actually talked about very recently can be pretty wild. The fifth one, where new taxes can be enacted. The final way your taxes could be affected, and they just make up new ones. One of the things that was actually discussed recently in Congress was this. If you have a big IRA, okay, or 401k, and you have deferred money, gee whiz, you're just not going to need all that money. So what we want you to do is every dollar that you get over the congressionally mandated limit, we want you to cash in half of it and pay taxes on it and get it out of your 401k or your IRA. So you're no longer allowed to keep that money on a deferred basis. The proposal would require savers above a cap to withdraw from their accounts 50% of the excess above the cap each year. So every time you made new money, if that puts you above the cap again, you got to take half of it out and pay taxes on it. So it's an RMD plus. You still would have to take your required minimum distributions at 72. But if you have a larger IRAs, now remember, add them all up. Okay, you might have this IRA, that 401k, that 401k, add them all up. And if it goes over a certain limit, that which they will tell you what the limit is when they're ready, if they do this. Now, they didn't do this one. But if they're talking about things like that, what will they come up with? Because one of the things we all do know is that it's a pretty important time to be considering future taxation. We're at $30 trillion, which is an impossible number to wrap your head around. We're talking about the new spending is going to save us $300 million or $1 billion, which is nothing. I mean, that's like a tenth of it. It's just a ridiculously small amount based on what we actually owe, but it's a huge number in and of itself. Simply put, there's every reason to believe that Washington will be searching for more tax revenue in the near term. And recent congressional debate shows retirement accounts are the key place that Congress will look. So if you have IRA accounts above certain levels, now what's that level? Well, we'll talk about that if you want to, but we've always talked to you guys about doing Roth conversions or other types of structures to put you in more of a tax-free environment. The other aspect that I didn't talk about here, but it was mentioned in several cases, is what we call legislative risk. There's really two kinds. Tax rate risk, which they can change when they want to, but who changes it? The legislature. So if the legislature wants more money and they have the power to change the rules, what do you think is going to happen? And one of the things that they're not likely to be able to change is contractual law. So even though they may be able to change brackets and all these other things, one of the things that we might want to consider more heavily than we ever have before is using things like cash value life insurance, index universal life, but a contract is much more difficult to change than a traditional structure. So putting your money over into that type of planning is becoming, quite honestly, a lot more attractive than it ever has before. And it's always been a really good plan based on the type of structures that we have and use today. But if we've talked about it ever before, it might be time to talk about it again. So I'm going to leave it at that.
Thank you very much, Mel. Appreciate that. And we go from there. Legislative risk is, I believe, one of the biggest risks that we are going to be facing in the future. And I'm going to talk a little bit. The last couple acts that Congress has come up with, I cannot figure out where they got the name. The Secure Act, in my opinion, for most retirement accounts, is insecure. It should have been called the Insecure Act. Why? Because they got rid of the stretch IRA. They had promised us years ago that if we didn't spend it during our lifetime, our heirs could spend it over their lifetime. They changed that. They looked at it and said, no, the heirs got 10 years unless they fall under certain different categories. So that risk did jump in and it has hit people. The last bill that was just passed, the Inflation Reduction Act, I'm still trying to figure out where the inflation reduction is coming from. The only piece that I can get from it that I believe will be advantageous to our clients is that now Medicare will be able to negotiate with the drug companies the cost of prescription drugs, which has never made sense to me why that hasn't been in there from the beginning, but it is currently in there now. There is also some language in there that can put it so that the amount that people that are on Medicare, what their drugs can cost over a year. So that is part of what I would call some of the cost reduction side of it, but we put $369 billion towards climate. One of the things that has came out of this, the quote credit that somebody would have gotten for buying an electronic vehicle prior to this act was greater than the credit that they're going to get after the act, because there's so many strings attached to the new credit for electronic vehicles that almost nobody can actually get it. There's going to have to be a lot of changes within the companies that make electronic vehicles for people to actually get the credit that is coming from. So if you were thinking about that, please, let's look at it and find out, will you still get the credit that you thought you were going to get before? The other thing that people have asked me about, they're going to give the IRS an extra $80 billion to quote, go after. Are they going to send out an army of agents? I'm going to sit here and say, no, I do not believe that they are. Some of the things that they were doing, I could not believe when I heard that some of the computers that the IRS works off of actually uses the language COBOL. That is a 50-year-old language that I learned in college. And that is still the language that some of the quote IRS computers are ran on. So updating technology will be a lot of the money that is being allocated to the IRS. There will be more agents out there. You can tax the quote poor are not going to get hit because there's not a lot of money there. It's like, I like to call it the McDonald's theories of taxes. Go where the money's at. The upper middle class and the upper class are the ones that are going, because if something is done incorrectly, that it will get caught and there are more monies to be made. But they're not worried about my W-2, I reported the wrong one, or I forgot a 1099. Those things are already picked up through the IRS. So I am not a major concern that, everybody and their brother's going to now start getting audited. because it does not make sense to do an audit if there's not the availability. I have been through 5 IRS audits throughout my lifetime between businesses and personally, with very little to no changes on anything that I've ever had done. The idea around it of it is if you're not doing something wrong, you do not have to worry about the IRS problems that we have. One of the ways that they're going to supposedly pay for this bill is they're putting an alternative minimum tax on some of the largest corporations in the world. And then they're also looking at what they call stock buybacks. When a company says we're going to buy back some of our own stock, what does that do? It decreases the numbers of shares out there so that there's a larger value of the company. There's going to be a tax on that. So those are the ways they're going to pay for it. Again, I don't know how much of that is in the area of inflation reduction. You know, we're not sure. A lot of people could be excited when the quote government lets us know how much Social Security will be raising next year. We also got to figure out how much Medicare is going to be raised next year because of inflation. So those are the numbers that are going to be coming out, and those are the things that we will continue to follow to figure out how taxation, inflation are going to affect you in your retirement years. Again, I want to just mention those dates. If you got a pencil, pen, write them down. Events that people could refer somebody to. The 23rd of September, we're going to be meeting right here in the office of the Aul Financial Group. You can come in. It's been painted and done everything like that. We can't believe we've been here five years. But if you'd like to come by the office, the open house, bring a friend with you. Girls just want to have guns, probably will fill up on September the 14th. If you'd like to bring somebody and bring a guest, please give us a call. We'll see if we can get you on that if it already does not have a waiting list. Maggiano's Little Italy down in Clayton, September the 27th and the 29th. And then Miss Deanna with the Women in Wealth, October 4th and October 6th at El Balago. So if you know somebody that it might be advantageous to have them come sit and talk to myself, Mel, or Deanna at the ladies' events, please give the office a call here. Let's get their names and let's get them on the list. Again, I want to thank everybody out there for being a part of our family.